How to analyze annual report by analyst. Today I am going to discuss you about uh, generally whenever we are going to take share market shares, we don't know whether the company is doing well or not. So in order to understand that, we need to analyze annual report. So this is a disclaimer that this this is prepared for educational purpose. If any more concrete information is required, you contact the experts in finance. So there are many what are the components of an annual report? In annual report, you will have very big books which has hundreds of pages. So in that, you must concentrate on these three. My according to me, one is the balance sheet, the second one is the profit and loss statement, the third one is the cash flow statement. So you have to compare with the previous year. So there will be 2 years, last year, this year. If assets, you have to see whether the asset is same as the last year or if it has increased or decreased. If it has increased, it's good, positive. If it is not increased and it has decreased, it is. So what is current assets? So current assets are like FD, any receivables from other company, etc. So receivables also you are required. Generally in power companies, etc., you will may some of the funds may not be receivable or receivable. So this you have to understand. Next, the total equity. What is the total equity part of this in the market, in the company, and what are all the liabilities we have to see. The next one is consolidated profit and loss. So if you have a Britannia Parle-G company, so what is after selling 1,001 crore Parle-G, how much you will be earning? So out of that, you will remove all the expenses, employee benefit, etc., and then you will go be calculating what is the tax. So after that, what is the profit and what is the profit per share, and this profit is sometimes shared with the shareholders as a dividends. So all this we have to see. Next is cash flow. So what is the mutual funds, what are all the plant equipments, etc., fixed deposits, what is the cash flow. So this is also very important, whether it is positive or negative. So next is gross profit margin ratio. So here we will be seeing what is the gross profit of the company before taxes and what is the sales. If this ratio is ideal, but higher 20%, it's good to invest. 10% it is cause of company because the company is not earning enough profit. Next is net profit margin. It is also 10%. If the company is net after taxes, it is earning, it is good. If it is less earning 5% and all, it is very cause of concern. Next, return on investment. That is now total operating profit and divided by total long term and short term sources of funds. So this return on investment should be 10% or higher. Next is return on equity. So what is the equity holders, how much they are getting per profit? If equity funds will be there, so if we divide the equity funds by total profit for equity, then we'll, so this return of interest equity must be 15% or higher. If it is less, it is a cause of concern. Next, debt equity ratio. So if there is a debt, the company raises funds. One is through equity, the second is through debt. If debt is higher than 3:1, it is very risk. Generally, it should be lower than 2:1. Earning before interest. What is interest coverage ratio? Suppose a company is doing business, so it will have been taking some debt. So if that debt is they are paying interest, so this ratio earning by interest is 1, it indicates they are paying all the interest only. If it is 1.5 to 2, it's minimum interest. If it is higher, then it is good. Current ratio, current asset by current year, it is liabilities. It is this ratio gives the indication that whether the company is able to fulfill its obligation. Generally 1.5 is to 1 is or higher is good. Asset test ratio, quick assets by current liabilities. If quick assets like FD etc are there, this ratio should be it has liquid assets and it can do some work, so it has capacity to do work is indicated by this asset test ratio. Earning per share, so this is very simple, total net profit by number of equity shares. So this is equity shares. So you will, if earning is more, it's a good company or investment is fulfilled. Next, P by E multiple. Price to earning ratio is the financial ratio that measures the company's current stock price relative to its earning per share. So if it is around 20, it's good. So it is bit depends upon whether it's the company is having a strong whether emerging industries etc. This is shares. This P by E growth ratio, price to earnings growth is also a very important ratio. That is, if the ratio is 1, it is good, and if the ratio is greater than 1, suggests that the company is overvalued. So let me go again to price bar earning ratio. So what is price bar earning? Market price is 100 rupees, earning per share is also 100 rupees. This indicates that what is the actual price to earning ratio. Generally a higher price to earning ratio in earning ratio, for suppose what Infosys earning is 350 rupees but market price is 1700, so it indicates that people are like to spend more rupees or dollars and it is having people have faith that the company will grow. While the same this price by earning P by E ratio by growth gives us a picture whether the company has a growth potential. So if the ratio is 1 less than 1, then it is considered favorable. If it is greater than 1, it is the stock is overvalued. The next ratio is the value of company. This is given by stable cash flow by return of rate. So this price of the share to book value suggests that the company whether it is overvalued or undervalued. There are many ways to calculate it. What is book value of the share? Book value is nothing but net asset, total asset of the companies divided by total number of share. This is the book value. If we consider the book value of the share and actual value, which is the market price, we will be able to understand whether the share is undervalued or overvalued. Thank you. Thank you for listening to the how to analyze annual reports. Stay tuned for other videos on the similar subjects. Thank you.